Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're taking a close look at Axon Enterprise, Inc. Now, this is a company with a really ambitious mission to protect life in service of promoting peace, justice, and strong institutions.
That's putting it mildly. And they even have that moonshot goal, right?
Exactly, to cut gun-related deaths between police and the public in the U.S. in half. By 2033, that's quite a target.
Huge.
So our deep dive today is into Axon's latest financial report. It's their Form 10Q for the quarter ended June 30, 2025.
And this isn't just, looking at numbers on a page.
Not at all. It's really a window into how a company with this kind of vision is actually performing, how it's structured for growth.
And so surprising challenges and opportunities they're facing.
Definitely surprising. You'll discover how Axon managed significant revenue growth while somehow reporting an operating loss.
We'll get into that. Big financial moves, too.
Massive plays, and how they're navigating some tricky accounting stuff, plus these fascinating legal and operational risks.
Including AI, which is a huge topic everywhere now.
Right. It's really a peek behind the curtain at a company on the front lines of public safety tech. So let's explore.
Okay, so Axon really positions itself as a technology leader in global public safety. Their big idea is building the public safety operating system of the future.
So not just one product, but a whole integrated thing.
Exactly. A suite of hardware devices and cloud software solutions all working together. And they're targeting, modern policing, federal agencies, corrections, justice, even enterprise security. It's broad.
And to make sense of it all, they've actually restructured recently. Two main segments now.
That's right. As of late March 2025, they split into connected devices and software and services.
Okay.
And they restated the old numbers, which helps for comparisons.
Good. So let's start with connected devices. What falls under that umbrella?
Well, that's where you find the hardware. Your taser handles, cartridges, the warranties for those.
Yeah.
Also, personal sensors, think body cameras, accessories, signal sidearms, that kind of thing.
Got it.
And then platform solutions that include interview room tech, fleet and car video, fixed cameras, drones, counter-drone stuff, even VR training hardware, a whole lot of physical kit.
Okay, quite a range. So how did this hardware side do in the last quarter?
Pretty well, actually. Net sales for connected devices jumped almost 29% for the quarter ending June 30th, and over 27% for the first 6 months. So strong demand there.
Those are solid numbers. What's driving that? Any specific products really taken off?
Yeah, the report points to a few things. Higher volumes for their Taser 10 handles and cartridges, continued adoption of their newest body cam, the AB4, and also increased volume for counter-drone gear and that VR training hardware we mentioned. So new stuff is clicking.
Makes sense. Investment paying off. Now let's flip to the software and services segment. This is usually the sticky part, right? The recurring revenue.
Absolutely. This is mostly their cloud-hosted digital evidence management, think Axon Evidence, plus productivity tools and real-time operations software. It's like the brains managing all the data from the devices.
Making it useful for law enforcement and others.
Exactly.
And how did that side perform? I feel like that often grows even faster in tech.
You're spot on. Net sales for software and services surged almost 39%, both for the 3 months and the 6 months ended June 30th.
Wow, nearly 40% growth. That's accelerating.
It really is. Suggests platform strategy is working well.
So what's behind that growth? New customers signing up or existing ones buying more?
It looks like a healthy mix, actually. The report says it's driven by an increase in the total number of users, for new folks coming on board, and also existing customers adopting more of the premium add-on features.
The upsell, that's key for software.
Definitely. Shows customer loyalty and that they're finding value in the upgrades. Helps build that recurring revenue base.
And geographically, still mostly a U.S. story, or are they expanding?
It's still heavily weighted towards the U.S. About 80 to 84% of sales are domestic, but international revenue did increase, mostly driven by sales in the Americas region outside the U.S.
Okay, so U.S. is core, but international is growing. Makes sense. All right, let's get into the big headline here, the financials. Axon delivered some really impressive top-line growth. Net sales, almost $670 million for Q2 25. That's up nearly 33%.
And $1.3 billion for the first half, up over 32%. Strong numbers.
Very strong. But here's the head scratcher. Despite that booming revenue, they reported an operating loss. Went from what, over $33 million in operating income last year?
To a $1.0 million loss this Q2. and nearly a $10 million loss for the first half of 25.
So what gives? How do you grow revenue that fast and end up with a loss?
Yeah, that's the central question, isn't it? And the answer really boils down to a massive, deliberate increase in their operating expenses.
Okay, so spending went way up.
Way up. Think of it like they're just pouring fuel on the fire for future growth. Their selling, general, and administrative costs, SG&A, jumped by over $70 million. That's almost a 42% increase in Q2 alone.
Wow.
And for the first half, up over $140 million, or nearly 45%.
What's in that SG&A bucket that drove such a big increase?
A big chunk is headcount. They hired a lot more people. There's also substantial stock-based compensation. Giving employees equity is great for alignment, but it's a non-cash expense that hits the P&L.
Right, especially with things like their 2024 employee stock plan and the CEO Performance Award mentioned in the report.
Exactly. Plus higher wages generally and more spending on sales commissions and things like in-person events as things open up.
So investing heavily in people and market presence. What about R&D, research and development? That must be huge for a tech company like this.
Oh, absolutely huge. R&D expenses climbed by over $60 million in Q2. That's a 60% jump.
60%?
Yeah, and over $120 million increase for the first 6 months. And the drivers are similar. More headcount, more stock-based comp, higher wages for those tech folks.
So the picture emerging is they're consciously choosing massive investment over short-term profit.
That's exactly it. It's a classic growth company strategy. They're betting that these big investments in people, tech, and market reach will lead to much bigger returns down the road. Long-term dominance over immediate profitability.
Okay. And how did all this affect their gross margins? You know, the profit left after the cost of the goods themselves.
Some moving parts there. For connected devices, the hardware side, gross margin actually dipped slightly to about 48.6%. The report says that's mainly because they sold more platform solutions, which tend to have a bit lower margin than, say, tasers.
Okay.
But on the software and services side, gross margin increased to over 75%.
Very healthy.
Yeah, driven by a higher mix of software, which inherently has better margins. Overall, though, the company-wide gross margin was pulled down a bit by that higher stock-based compensation, which gets spread across the segments.
Right, that stock comp shows up everywhere. Now, beyond just operating expenses, Axon made some really big financial moves. They issued a lot of debt back in March, didn't they?
They sure did. $1 billion in senior notes due 2030 and another $750 million due 2033. So $1.75 billion in new debt.
That's substantial. How did that flow through to their interest expense? Must have shot up.
Dramatically. In Q2 2025, interest expense hit nearly $29 million. Compare that to just under $2 million in Q2 of 24.
Huge difference.
Massive. And for the first half, over $36 million versus about $3.6 million last year. So that debt servicing cost is a major factor in pushing them towards that operating loss we talked about.
So they're using debt to fund that aggressive growth in R&D spending.
Seems to be the strategy, yes.
And there was also this other thing, an induced conversion of some older debt. That sounds complicated. What was that about?
It is a bit technical, yeah. Basically, back in March, Axon struck a private deal. They convinced holders of about $407 million of their older 2027 notes to swap them early.
Swap them for what?
For a mix of cash and Axon common stock. Because they offered an incentive to do this swap early, it's accounted for as an induced conversion. The main impact for our discussion is that it resulted in a one-time non-cash expense of about $28.7 million. It hits their other income loss line, impacting net income, but not really their operating cash flow.
Okay, so another factor contributing to the bottom line loss, but more of an accounting event.
Right.
So big spending, big debt. But they also seem to be playing a bit of a venture capital game on the side. Strategic investments and divestments?
That's a good way to put it. They definitely made some moves. They spent over $215 million to buy more equity in a company they'd already invested in. But then for another investment they held, they recognized a big gain over $167 million just because its market price went up based on observable data.
Nice gain without selling.
Exactly. And then they did sell some of their interest in that same investee. They got over $340 million in cash for it.
Wow.
And booked a gain of about $320 million on that sale.
So these investment activities actually provided a significant boost to their overall financial results.
They did. It's just important, to separate that from their core operational performance, selling tasers and software.
Good point. So with all this spending, debt, and investing, how is their actual cash situation? Do they have money in the bank?
Oh, yeah. They're sitting on a very strong pile of cash and equivalents, over $615 million as of June 30th. Plus, they have another $1.5 billion parked and available for sale investments.
Okay, so liquidity isn't an issue.
Not at all. A lot of that cash came from issuing those senior notes we discussed,
Yeah.
and they also have a $300 million revolving credit line that they haven't even touched. So, plenty of financial flexibility.
Okay, now for perhaps the most head-scratching number in the report, their income tax rate. For Q2, it was listed as 192.9%, and for the first half, negative 78.5%. How on earth do you get a tax benefit on a pre-tax loss, especially one that high?
Right. It looks completely bizarre at first glance,
Yeah.
but it's actually an artifact of tax accounting when you have certain items interacting with a pre-tax loss. The main things driving this are the tax benefits from stock-based compensation and R&D tax credits. These are generally favorable tax items. But when you apply these benefits to a pre-tax loss, mathematically, they can magnify the benefit dramatically, making the effective tax rate percentage look really strange, even positive like that 192.9% or negative like the 78.5%.
So it's not that they paid 192% tax, it's that the benefit relative to the loss created that percentage.
Exactly. The dollar amount of the tax benefit isn't necessarily enormous, but as a percentage of the small pre-tax loss, it looks huge.
Yeah.
It's somewhat offset by things like limits on deducting executive pay and some uncertain tax positions, but yeah, the core reason is that magnification effect.
Fascinating. Accounting can be weird.
Tell me about it.
Okay, let's shift gears a bit. Under the hood, looking at controls and compliance. Weren't there some accounting revisions mentioned for prior periods?
There were, yeah. They had to go back and correct some prior financial statements for what they termed immaterial errors.
Hmm.
It was mainly about how they accounted for revenue from certain reseller deals, basically, where they're the principal seller, or just acting as an agent. That affects how you book the revenue.
Yeah. Okay, so classification stuff. And internal controls. Are those solid?
Well, they're making progress. They mentioned they are still working on fixing a previously identified material weakness related to revenue recognition. That's ongoing. But good news, they did successfully fix another material weakness, this one related to how they accounted for that convertible debt we discussed earlier. So remediation is happening.
Right, okay. Now, operating in public safety, especially with tasers and body cams, they must face a fair amount of legal risk, right?
Absolutely. It's a high-stakes environment. The report details a few key areas. First, product liability. They consistently face lawsuits alleging injury or death related to taser device use.
How do they handle those?
Their stated policy is pretty firm. They say they don't settle suspect injury or death cases, and they self-insure the first $5 million of each claim.
So they take on significant risk there themselves.
They do. Then there's an antitrust class action suit.
Ah, yes, related to an acquisition.
Right, stemming from the FTC's previous look at their 2018 acquisition of Viv, a competitor in the body cam space. The FTC dropped its case, but now some municipalities are pursuing a class action based on similar claims. Axon denies it all.
And patents.
Yeah.
Always a battleground in tech.
Yep. There's a suit involving drone technology. Airspace Systems sued Drone, a company Axon acquired last year, and Axon got added to the suit. But it's currently paused while Axon challenges the patents themselves.
So definitely keeping their lawyers busy.
No doubt.
Now, for some of the, let's call them aha moments in the risk factors, things that really make you think. AI stands out. They're using it, but it comes with baggage, doesn't it?
It really does. It's a double-edged sword. The report is pretty candid about the risks. There's the obvious risk of, unexpected failures or the AI just being inaccurate. In public safety, the consequences could be severe.
And bias. That's always a huge concern with AI.
A major one. The report specifically mentions the risk of AI models trained on biased data sets. They even cite that ACLU report from late 2024, which flagged how this could lead to discriminatory outcomes. That could seriously erode public trust.
Huge ethical tightrope to walk. What about regulations?
That's another big uncertainty. The legal landscape for AI is still being built. The report mentions things like the EU AI Act, which puts specific rules on AI used in law enforcement. This means higher compliance costs for Axon, potential limits on what they can develop or sell, especially internationally.
And cyber attacks.
Yeah, attackers are getting smarter using AI themselves. So the threat landscape is constantly evolving. It really poses a question for you, listening. How do companies like Axon balance pushing innovation forward with these really serious ethical and safety considerations, especially in a field like this?
It's a tough balance. What other risks jumped out at you? Supply chain, maybe.
Definitely. Supply chains are a perennial issue now. Axon relies on suppliers here and overseas. Some components only come from a single source.
That's always risky.
Very. They specifically call out challenges for the TASER 10 because of its unique design and regulatory needs make switching suppliers hard. Plus, they face risks from potential tariffs, global conflicts, they mention the Middle East and Ukraine, high inflation, and those ongoing semiconductor issues. All that can jack up costs and delay deliveries.
A lot of external factors they can't fully control.
Right. And then there's human capital, people.
Always critical in tech. Who are they reliant on?
Well, they mention key executives, particularly Patrick Smith, the founder, CEO, and chief inventor, basically. Losing key people is always a risk. But it's broader, too. Attracting and keeping top tech talent, especially people with AI skills, is fiercely competitive.
And things like immigration policy can affect that?
Yeah, they mentioned restrictive U.S. policies like for H-1B visas making it harder. Even stock price swings can impact their ability to use equity to attract talent.
Interesting. I also saw a note about their subscription model having a potential downside. Seems counterintuitive.
It's subtle. Subscriptions are great for predictable revenue, which investors love. But as more revenue shifts to subscriptions, it means they collect cash more slowly, spread out over the contract term instead of upfront.
Ah, so it impacts immediate cash flow.
Exactly. And it slightly increases customer credit risk because you're waiting longer to get paid.
Right.
It's a trade-off for that predictability.
Okay. And finally, brand reputation. In this space, that must be absolutely vital.
Paramount. Trust is everything in public safety. The report emphasizes that negative publicity, even if it's unfair or totally outside their control about their products or how they're used, can seriously hurt sales and their brand image. They operate under a microscope.
Makes sense. A lot to juggle.
Yeah.
So let's try to wrap this up. What does this all mean for Axon Enterprise? What are the big takeaways from this deep dive into their Q2 report?
Well, Axon is clearly a company moving fast. They're growing their core public safety tech business at a really rapid clip. They are making huge strategic bets on their future, pouring money into R&D, making acquisitions, and funding it significantly through debt.
But it's not simple growth.
Not at all. That growth comes with real complexities. They're managing these massive operating expenses that lead to losses right now. They've got unusual tax situations. They're fighting legal battles on multiple fronts. And they're dealing with these significant risks, global supply chains, the war for talent, and especially the tricky integration of AI with all its ethical and operational challenges.
A company with a bold vision facing equally significant challenges.
That sums it up well.
Okay, so here's something to think about as we finish. Given Axon's really ambitious moonshot goal, cutting gun deaths in half, and their position right at that intersection of technology, public safety, and ethics, consider this. How might Axon's success or failure in balancing its financial needs with responsible innovation and managing all these risks, how might that actually shape the future of law enforcement and citizen safety itself? What kind of trade-offs, if any, do you think are acceptable when you're pursuing a safer world using technology like this? Something to mull over.